Hey there, have you ever been confused by the different business terms that are out there and you're wondering which ones are important and which ones should you pay attention to? Well, in this video, we're going to break down and go over some of the finance terms that small business owners should know. Hey, badass business owner, welcome back to our videos. You know, here's the thing. There's so many different terms that are out there that sometimes it gets really confusing if you need to know these or not. So all you do is you say, way too much work. I'm just going to go do some sales and I'm going to go make some money. Here's the thing. You do need to know some of these terms. So let's kind of weed through the hundreds of terms that are out there and at least go over a few you should at least be familiar with and at least understand. Because with so many terms out there, what do they mean? Should you know them? Should you not? That's what we're going to take a look at. All right. So which ones should you know and which ones you shouldn't? Let's take a look. All right, so there's four buckets basically that these terms are going to fall into. One are financial reports that you should be familiar with. You've got some profit and loss terms that you should know and understand. There's some general finance terms that you should understand, and there's some general business terms that you should understand. So let's take a quick look at each of these buckets. But don't worry, I'm not going to blow your mind off, okay? I'm not going to make you go, oh my God, and you'll be sitting in the corner sucking your thumb, wondering what to do. It won't be that bad, I promise. We're just going to work our way through. We're not going to spend a lot of time on each of them, but I just want you to be able to understand the basics. So on financial reports, the big one, the big daddy of them all, is the profit and loss income statement. It is your business scorecard. Sometimes it's called a profit and loss. Sometimes it's called an income statement. But at the end of the day, it is the number one report in your business. So it's really, really important that you understand it because it is the flow of money in and out of your business. Now, another report that you'll hear about is called your balance sheet. And it is a financial report that basically shows you a snapshot of time of your business and what your assets are, the money that you have in your business, the liabilities that you have, and how much cash you should have on hand. If you have a P&L service or a bookkeeper, a lot of times they'll give you this report. It'll be in the packet, the stuff that they give you, because it just basically highlights, like I said, those assets, those liabilities, and the capital. Capital is money. We're going to cover that term here shortly. It's just a snapshot in time, basically, and usually you get them at the end of the month, snapshot of the company's net worth at any given time. Now, you'll also hear something called break-even report, and a break-even report is just basically so you have an idea of when your expenses match the sales you've got taken in. So it's as if you took $1 in and every dollar went right back out. It's a break even. How much do you have to do in sales to cover all of your business expenses to break even? All right, just to get to zero. That's basically all it is. Uh, Now, it's important that your business know this because if you have seasonal swings, months that go up and down, you need to know at minimum what you need to do in sales so that way you don't go into the red and have to go into pocket to come up with more money. And it helps you with that inconsistency that happens because most businesses do not run the same month to month. This one you've probably heard about, a business plan. It's basically a plan that you put in place to grow your business. And it's a roadmap on how you're going to get it. It's going to have some financial information, some operational information, marketing goals, and how you plan to get there. Most of you, you don't really need one, but if you're going to borrow money, typically a bank or somebody who is going to be giving you something in exchange, they want to see that business plan because they want to make sure that you are good for it. Now, let's go to bucket two, which are the profit and loss statement terms. I do have a video series that breaks this down even more, so we're just going to highlight them really quickly. You have the revenue line of your P&L. Revenue just is basically sales or income. Sometimes it's called revenue, sometimes it's called sales, sometimes it's called income. It's basically any money that you take in to the business. So when you heard the term revenue, it's just money you take in. Cost of goods sold. Sometimes you'll hear it called COGS. Cost of goods sold, you might understand that a little bit better than hearing the word COGS. But for some of you, you hear COGS, 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 and you're like, what the hell are they talking about? It's just your cost of goods sold. It's basically the cost associated with you creating your product or your service. Then you're going to have gross margin dollars. It's just your revenue, your sales, your revenue minus your cost of goods sold. So your revenue minus your COGS is going to give you your gross margin dollars. It's the profits prior to paying for any of your expenses. So you need to know that this is, if you watch the P&L series, I'll tell you, this is the one section that people tend to lose the most money because they think they can put all that money in their pocket. And the reality is you can't. They're just gross profits. It's before you pay the rest of the bills. And that's what gross margin dollars are. Then you have your operational expenses. It's the overhead to run the business. It's the rest of the money that is spent on keeping the business afloat, such as your rent, your marketing, utilities, accounting, legal, payroll, other costs, admin support, taxes. I mean, there's so much stuff that goes into that. It all adds up. It's important that you understand your operational expenses. You get to the bottom of that P&L, you're going to have your profit and loss. Revenue minus COGS minus those expenses is going to give you your profit or loss. It's a loss if your COGS and expenses exceed what you take in. So basically, if you spend more money than you take in, it's going to be a loss. Otherwise, you're going to have a profit. And this is when your business makes money. You're also going to hear sometimes associated with your profit and loss statement, retained earnings. This is profit that you have that you leave in the business. And you're going to do this because it's very similar to a savings account. It's going to allow you to get through the slower months because sometimes you got to rob July to pay for December's bills, or you might need to save up money so that you can purchase some new equipment or some other additional items to grow your sales. Retained earnings is just money you leave in the business so that you can grow the business. Your profit margin, a lot of times it's called the financial health of the business. At the end of the day, it's the true profits at the end of the day that you have, and profit margin just is as a percent of sales. So for example, do you keep 10%? Do you keep 20% of your sales? That's all it is. It's just taking the profit and divide it by the sales, and that's going to give you that profit margin. Here's just an example of it. 25% just means you keep 25 cents of each dollar. Now, if you check, like I said, if you check out the videos on profit and loss statement, where we break it all down for you, and there's one video that goes all the way through, and then there's a series of videos as well. We've got a couple different ways for you. So general financial terms that you need to understand. Accounts receivable. Especially if you don't use a bookkeeping system, you've probably never heard of this, or the very first time that you signed up for your QuickBooks or any of the other ones, you kept seeing this word accounts receivable going, what the heck is that? Basically, this is money that is owed to your business at any given time. So the minute that you do a job for somebody and somebody owes you money for it, it's an account receivable. It's money that you should be receiving. The business should be receiving. That's all it's talking about. It's money owed by your clients or customers. So in those bookkeeping systems, and to our CPA nerds, it's called accounts receivable. It's considered an asset on your balance sheet because it's legally owed to you. So a lot of times you're collecting the money before you do the service, but if you bill somebody after the service, for example, let's just say you have a regular client that you see on a monthly basis, sometimes you'll do the service and then they turn around and they pay you. Believe it or not, that's an account receivable. It means they owe you money. That's all that means. Accounts payable is the flip side of that. It's money you owe to your suppliers, your vendors, or to somebody else. It's the business's obligation to pay debts that are owed to lenders, suppliers, creditors, or anybody else. So if you have a credit card, you have an accounts payable because you have to pay that monthly payment. If you have vehicle payment, stuff like that, it's an account payable. Same thing with rent or anything else. It's considered a liability on your balance sheet because it's money that the business owes and has to be paid no matter what. Accruals, it's just basically a list of expenses that have incurred but are not yet paid. So accruing, it just means it's building up. Okay, think of that. If you're accruing a bunch of money, you're gaining a lot of money. You're accruing, you're pulling together. Sometimes it could be sales that have yet to be have been completed, but they haven't been billed yet. But it also could go the other way around. It could be money that you owe to other people. Now, two terms you've heard is accrual. You might have had someone ask you, are you on an accrual basis accounting or are you a cash basis? Well, here's the difference between the two. Accrual basis, basically in this method, it's counted as it's earned and when it's occurred. So even though you may not pay that for a month, you're going to count it today because you owe that money. So in an accrual basis, it's just a matter of when you do it is when you count it. A lot of small businesses, this does not pertain to you, because for the majority of you guys do it all in real time. So you typically are on what's called a cash basis accounting. Basically, it's recorded when you make the payment and when you get it and when you send it. So cash basis is you do it in real time. That's when you count it. Most of you guys are going to be on a cash basis accounting. So when people ask you, are you accrual basis or a cash basis? For the majority of you, I'm going to bet you're on a cash basis, depending upon the type of business that you have. There are some of you on an accrual basis. It just, like I said, it really depends upon the basis, but most small business owners like yourselves are going to be on the cash basis. Big companies are going to be on the accrual basis. Depreciation, this is basically where it's more of a tax term. It's where you get to depreciate the cost of something slowly on your taxes so you can pay less taxes. So it's decreasing the value. We've all heard about how the minute you drive a car off of the lot, it's worth less. And you're going, why? It's basically the same car, whether I'm sitting on the lot or if I drive off the lot, but they discount it dramatically right afterwards. It's because they depreciate it, because they say that value is no longer worth that same amount. Well, the equipment and vehicles that you have in your business, they do the exact same thing. That's what depreciation is. The cool thing is they allow you to mark off a little bit from your taxes, so you pay a little bit less taxes. And mainly it's going to be used on larger items, high ticket stuff. So it's not going to be on your little, if you buy something for $1,000, you're probably not going to use it, or they'll let you write it all off in one shot. But in most cases, it's something that's done over multiple years. So it could be 5 years, 7 years, 20 years, 30 years. It just depends. ROI is just your return on your investment. You've probably heard about this one. This one's really important because as you start to run your business better, you just want to know that for every dollar you spend, what is your investment? What do you get back for that? So for example, if you spend $1 and you get $2 back, your return on your investment is that additional dollar. But if you spend $1 on something and you get nothing back, then you've taken a loss on that return on your investment. So when you're spending money in your business, when you do advertising, it's a great example of it, is when you spend $100 on advertising, you expect to make more money for it. So even though it might be very painful to spend, say, $500 on advertising, if it's going to get you $3,000 worth of additional profits, it's worth doing. But the mistake people make is they go, well, I'm going to get $3,000 in sales. Well, you don't get to keep all those sales. You have to look at the profits at the end of the day, and that is your true return on investment. We dive into that stuff in the podcast and in other videos, but it's basically ROI is your return on your investment, because otherwise you're just throwing money away. And that's why you really want to, this is one you really want to understand and how it works, because it's going to help you put more money to the bottom line. All right, some general business terms that you should understand. Assets, you've heard me say this one a few times. It's basically anything the business owns that has value. So if you own something in the business and it's part of the business and it has value, cash is a great one. It's got value. You can turn around and someone will give you at least at minimum the same amount of money back. I give you $10, you give me $10. It's an asset of $10. If I have a piece of equipment, even though it's been depreciated and it may not be worth, maybe I spent $1,000 on it at one point, it's only worth $100. It's still an asset because it's still worth $100. So it still has value. Like I said, it could be cash on hands, account receivable, money that's due to you, if you recall, buildings, equipment, inventory, anything else that can be turned into cash basically is an asset. On the flip side, you have liabilities. This is debt the business has. It's money that you owe. You have the legal obligation to repay somebody. So any invoices that are outstanding that you owe a vendor, a lease, bank loans, taxes, payroll, anything that you owe somebody else is considered a liability. Capital, this is the wealth of the business. This is the cash, the financial stability of it. It's cash accounts, assets, investments. Anything that you could turn into cash is considered capital. Working capital is stuff that you can do quickly. So for example, you might have something that might take forever, like maybe you have a piece of equipment that's not as popular as something else. So while it can be converted into cash and it is considered capital, it's not necessarily working capital because you probably can't flip it very quickly. So the difference between working capital and regular capital, working capital can be done quickly, but at the end of the day, all capital is cash value of the business. Now, cash flow, that's an easy one. That's the amount, how cash flows in and out of your business. So sometimes they'll take a snapshot at the beginning of the month and at the end of the month, and you're able to see this is what happened with the money that flowed into the business and out of the business. You don't really use it on a regular basis. You just want to know what that break even point is so you know how much cash needs to flow into the business. But if you ever hear somebody talking about cash flow, they're just talking about how much money is flowing into the business on a month. So let's just say you make easily $3,000 a month in profits, then your cash flow is about $3,000 a month is what you're taking in. So how much money is flowing through the business. Break even point, we talked a lot about this earlier. It's just where your sales, your revenue, is equal to the expenses and costs that goes out. So at the end of the day, if you take in $100, but your expenses run $100, that means a break even of zero. Break even is just for you to know what's the minimum you need to create and do in sales to cover all of those costs and expenses that you have. It's a very, very important number for you to know in your business, especially if you have a seasonal business, because you have to prepare for those rainy days. So you always know the minimum that you need to come up with. Burn rate is how fast you're going through your money. Let's say you have $100, but you're losing $50 every month. You have a burn rate. You're going to go through all that in about 2 months. So you know what the burn rate is. For that money, it's going to be gone in 2 weeks. You don't use this one as often, but if it does pop up, it's just saying basically how fast you're going through that money. It's really to help you through your cash reserves so that if you know you're going to burn through $2,000, $3,000, $4,000 in the 3 slowest months, you know you need to come up with that money at in your busiest time to set aside to be able to do that. So you need to know how much money you're going to burn through your slower months so that way you can get through. Bootstrapping, you hear this one all the time with small businesses. It's basically using your own money to start up your business and to grow your business. And then you're going to take the profits, the retained earnings that we talked about earlier, and reinvest them in the business. So you never, ever, ever take out debt. You're just bootstrapping it. You're using your money and then the business's money to grow the business. This is the ideal way to grow your business. Debt free. We want to be debt free. We talk about this on the podcast and in other videos. But bootstrapping, that's all they're talking about. So if you've never heard that term and someone keeps going, oh, you're bootstrapping, and you're like, okay, you don't know what they're talking about. That's all they're talking about. It's self-financing your business's growth. Now, there is a guide because there's all kinds of other terms that you need to know, and you're never going to remember everything that I just said. See the links below. And what I'm going to do is give you this guide that's got all kinds of stuff. You can just kind of keep it on your computer or somewhere. And if you ever need to look up a term really fast, it's one way that you can do it. So if you want that, you can go ahead and grab that from the notes. Remember, knowledge is power. And the better you get at the basics of your business, the better you're going to be at your business. So it's not that you have to memorize everything, but you need to know some of those key ones. So when you're having a conversation with somebody, because we want to level up, and you're going to want to have bigger and bigger conversations with people that are at the level you want to get to, they're going to be using these terms, and you want to be able to have a decent conversation and basic understanding of what it is that they're talking about. So having this understanding is going to help you dramatically. And by the way, if you like what you see and you learned a lot in this video, don't forget to hit the thumbs up so people know they should watch this video because they're going to walk away with some knowledge. And don't forget to hit subscribe so you can get all the other videos. I promise you we go into a lot more depth when it comes to knowing your business numbers and how to make profits and to grow your sales and all that good stuff. Don't forget to hit the bell because the bell is going to tell you in your email that something new has come out. And if you like listening to podcasts, taking knowledge on the road with you, listening in your car while you work, then we have the Badass Business Owner podcast that you can listen to either on YouTube or on your favorite podcast app. All right, we have done a lot here. And if you want to know your business numbers better, by the way, there is the Know Your Business Numbers course. Guess what? It's time to get out of here. Go be the badass that I know you are. All right, because that's why you've listened to this video. And we'll see you on the next video. Bye for now.